Joining us now to share his outlook, Eric Sheridan from Goldman Sachs. Eric, Happy New Year. Welcome. So you like Amazon, so you must not think this is bad for everybody. But Amazon had a great 2023. It was up, almost 80% during the year. So where's the upside to make some of these stocks, Amazon in particular, a top pick for you?
Well, thanks for having me on, John, and Happy New Year to you as well. When we look forward to 2024, I think the most dominant theme you have to continue to watch is who can put up sustained high single to mid-teens type revenue growth with a rising margin profile. Our top picks in the internet sector were really informed by that broad view in terms of the themes we saw that could potentially be drivers for growth. And then the margin dynamic gives you some valuation support as people grow into valuations looking further out than just 2023. The interesting thing about Amazon would be if you look beyond just the recovery in 2023 and look over multi-year views, the stock has traded sideways for long periods of time, going back to 2019. And one of the key parts of our thesis is returning to the profit levels seen pre-pandemic, plus the drivers of the ad business can power the stock from here.
Now, what about media? Media is a mess, I'm saying on TV, but you like Netflix, I think. It's been pushing higher for a year and a half. So what's the upside in picking that one since it's number one in the streaming era versus trying to figure out who's going to be number two?
So we're actually neutral rated on Netflix. I would say in streaming, what we're watching for is the consumption trends continue to move in the direction of the streamers and away from linear media. The ad-supported tiers, and one of the ones that just was launched or announced was Amazon, that will go into effect at the end of January. We think there could be another interesting tailwind for Amazon's advertising business in 2024. But YouTube and the growth we're seeing there in consumption and the engine of revenue growth that YouTube could continue to be a surprising force to the upside for Alphabet would be something that informs our positive view there as well on Alphabet and Amazon. And it's interesting when you think about it, bringing the power of intent being expressed on platforms to dynamic ad insertion into video platforms is going to be an interesting dynamic to watch for in terms of an advertising tailwind in 2024.
You like Uber, excuse me, you like Uber too, and the inclusion of the S&P 500 does what for that name?
Yeah, it's brought a lot of people into the conversation. When something's not in the S&P 500, I can tell you a lot of mutual funds and folks that are tethered to the index and trying to outperform it just don't have to bother and don't have to talk about it. So I think there's been two interesting backward-looking unlocks for Uber stock. Number one is the profit goals the company laid out at their investor day in 2022 and how they've executed against those goals through not only 2022, but 2023. So we're now talking about GAAP profitability for Uber as a driver going forward. So when you marry an ability to value the company on GAAP profitability with the index inclusion, you bring a much wider array of investors into the conversation. And it's frankly been probably one of the cornerstones of some of the incoming I've gotten from institutional investors around Uber, where frankly that was not there 2+ years ago.
Okay. I mean, what do you steer clear of in 2024? I see you got a sell rating, for example, on Airbnb. I mean, we've been talking about the shift from goods to services. I would imagine they would continue to be a beneficiary. You have a couple other sell ratings here, too. But what do you steer clear of based on your thesis in 2024 and why?
Yeah, travel is quite interesting because we're watching for the normalization of travel. We would rather play that through our buy rating in Expedia, where they've announced a buyback, and they're on track to buy back upwards of 40% of the company over the next couple of years. Airbnb was a pandemic beneficiary. We were able to work and live in a hybrid manner for a long period of time. And as travel normalizes and we get back to online travel being more of a high single-digit grower with certain levels of marketing intensity, we just worry about Airbnb's exposure to that normalization theme and the risk reward it presents right now as a stock. And generally what we try to stay away from is either normalizing growth, the need to invest in business models, or slowing growth in some of our more negative skews from a risk reward standpoint among our coverage universe, where if you look among our top picks in the year ahead, the hallmarks really are high single digit to mid-teens growth, rising margins, and valuations that present more interesting risk rewards looking out over the next 12 to 24 months. But it's interesting, not with the same return profile from a year ago. You know, a year ago, I was on with John and we were talking about 50, 60% returns in some of these stocks. You're not going to see the same level of return in internet stocks in 2024 that you saw in 2023.